Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey Prime investors, Martin Maxwell here, and welcome back to the 5-Minute Prime Podcast. Though today we're taking 10 minutes for a topic so critical, it's the entire foundation of your portfolio. I was reading an article from Benzinga the other day about a proposal for a 50-year mortgage. 50 years. The idea is that it could redefine home ownership and make housing more affordable. And my first thought as an investor was, would this make a bad deal good? The answer is a hard no. It doesn't matter if the loan is 50 years or 15 years if the property itself doesn't make financial sense. And this brings us to the single biggest mistake I see new investors make. They buy for appreciation. They buy based on hope. They hope the market goes up. They hope the neighborhood gentrifies. They hope the property will be worth more next year. Let me be crystal clear. Hope is not a strategy. It's gambling. Professionals don't hope. We calculate. We buy properties that are profitable the day we close. We buy for cash flow. Cash flow is the lifeblood of your portfolio. It's the defense that pays your bills during a recession, and it's the offense that funds your next deal. Today, we're going to dismantle the cash flow myth and show you what real cash flow actually is. This is the prepare and research phase of our prime framework in action. When you're starting out, it's easy to get seduced by appreciation. You hear stories of people who bought in a hot market and doubled their money in 3 years. What you don't hear about are the thousands of investors who bought in 2007, counting on appreciation and lost everything when the music stopped. Appreciation is the dessert. Cash flow is the dinner. You can't live on dessert. A property that loses you $300 every month is a liability, not an asset. It doesn't matter if it might be worth $50,000 more in 5 years. That negative $300 a month is a cancer in your portfolio. It drains your cash, starves your other investments, and puts you one bad month away from financial disaster. My point of view is this. You must only buy properties that put money in your pocket every single month. This is the fundamental mindset shift from amateur to pro. We run a business, and that business must be profitable. The first step is understanding what profitable really means. When I ask a new investor, what's the cash flow on this deal? They almost always give me the wrong answer. They say, well, the rent is $2,000 and the mortgage is $1,600, so it cash flows $400 a month. That answer is dangerously, catastrophically wrong. That $1,600 mortgage payment, that's just one of your expenses. It's what we call PITI, principal, interest, taxes, and insurance. That's the start of your expense calculation, not the end. True cash flow is your gross rental income minus all operating expenses. And the expenses you forget are the ones that will bankrupt you. This is where we separate the pros from the amateurs. The pros have a rule, account for every dollar. So let's talk about the expenses everyone forgets. I call them the 4 horsemen of cash flow killers. If you want to survive in this business, you must, I repeat, must account for these 4 expenses on every single deal you analyze. Horseman number 1, vacancy. Your property will not be rented 365 days a year forever. Tenants move out. It might take you a month or 2 to find a new qualified tenant. You must budget for this. A conservative standard number to use is 8% of your gross monthly rent. So on that $2,000 rent, you immediately set aside $160 every month just for vacancy. Horseman number 2, repairs and maintenance. Things break. Toilets clog, disposals jam, and faucets leak. This is the cost of doing business. You need a budget for it. A good starting point is 5% of your gross rent. That's another $100 a month from our $2,000 rent. Horseman number 3, capital expenditures, CapEx. This is the big one. This is the portfolio killer. CapEx is not the same as repairs. A repair is fixing a broken faucet. Capital expenditures is replacing the entire plumbing system. These are the big, expensive, inevitable items that have a long but finite lifespan. The roof, the HVAC system, the water heater, the windows. You will have to replace the roof in 15 or 20 years. If you don't save for it every single month, that $15,000 bill will wipe out 5 years of profit in an instant. You must budget for capital expenditure. A standard number is 5% to 10% of your gross rent. Let's be conservative and say 8%. That's another $160 a month. Horseman number 4, property management. But Martin, I'm going to manage it myself. I hear this all the time. And my answer is great. Pay yourself. Your time is not free. What if you get sick, go on vacation, or just get tired of tenant calls? You will have to hire a manager, and they charge 8 to 10% of the rent. You must account for this expense. even if you self-manage. It makes your deal analysis honest. So let's take 10% for management. That's $200 a month. Let's do the math again. Rent plus $2,000. Mortgage minus $1,600. Vacancy 8%, $160. Repairs 5%, $100. CapEx 8%, $160. Management 10%, negative $200. Your new real cash flow isn't $400. It's negative $220 per month. That great deal is actually a ticking time bomb, and you would have never known it unless you accounted for the four horsemen. My point of view is this: you cannot build a portfolio on hope. You build it on accurate, conservative math. The appreciation trap and ignoring the four horsemen are the two biggest reasons new investors fail. Your cash flow calculation is the single most important part of the research and invest phases of the Prime framework. Get this number right, and you're on the path to building a scalable, resilient portfolio. Get it wrong, and you're just a gambler waiting to lose. So your challenge today is to put this into practice. Go to any rental listing site. Find a property for sale in your area that has an estimated rent. Calculate the estimated PITI. You can use an online mortgage calculator. Then subtract the four horsemen. I want you to use a simple 30% rule for this. Take 30% of the gross rent and set it aside for vacancy, repairs, CapEx, and management. Is the number still positive? If it is, you might have found something worth digging into. If it's negative, you've just saved yourself from a bad deal in 60 seconds. You've just become a real estate investor. Next week, we get even more tactical. We're going to build on this foundation and construct a simple but powerful cash flow calculator in Excel step by step. And I'll introduce you to a new tool at reiprime.com that automates this entire process, letting you analyze deals like a pro in seconds. I'm Martin Maxwell. Keep learning, stay strategic, and keep building, one calculated move at a time.